Welcome back to Your Money, Your Call. It's Thursday evening, so that, of course, means we are talking shares. We've got Tom from Queensland who's been waiting. Hi there, Tom. Thanks for hanging on.
Hi, it's John. How are you going?
Good. John. Sorry, John.
That's all right. There's a couple of stocks I was interested in. I've been in United Group and AMP for 12 months, and up here in Mackay, they've just announced the other day they're doing some big work out at Moranbah, which is a couple of hundred k's west. And I just wanted to know what you thought of United Group and AMP.
I know in the funds management community that, they're well liked. I guess I sort of stand alone in saying, I think they're a mediocre business. I don't think they're a great business, and certainly not as great as the enthusiasm for them seems to be expressed by some of my peers. When it comes to AMP, and boy, oh boy, I mean,
interesting times for that company, though, isn't it?
Gee whiz, they were willing to pay, a ridiculous amount of money for AXA. NAB is now going. I mean, we talked about banks earlier.
Yeah,
Gosh,
if NAB, mix and everything.
But if NAB get AXA at the price they want to pay, I just can't bring myself to own the NAB. I mean, that's just for me, it's an absurd price. The way I look at valuing companies, it's Foster's buying Southcorp all over again. Like you've said, AMP's intrinsic value this year $5.71, next year $5.95. So the year after 2012. So not only is the share price at a premium to its intrinsic value,
because that's currently at $6.30.
I'm talking about AMP.
Oh, AMP is currently $6.25.
Yeah, so AMP is at $6.25, and so it's at a premium to $5.71, which is the intrinsic value of the company, and the intrinsic value is only going to go up to $5.95 in almost 2 years' time. So, it's not an investment case.
I might just mention, just for John though too, because Roger's 100% right in talking about the value. If John's got it or is looking at it, the price may well exceed the value because.
For a long time.
Yeah, and it's a good time for the funds management space. We've seen reprieve from a very difficult time, and FUM would be growing. They should be getting some inflows. They're in a business which is situated well to participate in all the upswing from compulsory super, ageing population. It's a good sector that they operate in, and their price could rise with the trend in that sector, even though they may not be worth that.
And what Jeremy's talking about is the price. Based on a good thematic. I've told you before, I'm terrible at predicting prices. I have no idea what the price is going to do. Jeremy would be a better man at that than I am. All I can tell you is what things are worth, and I know over long periods of time that price tends to follow the value. So he could be right. Over the 6 months, 12 months, price does really well.
It's also confusing for investors at the moment, isn't it? Because no one knows what's going to happen.
But no one ever does. I mean, that's precisely why I look at the value.
It's a fairly long, drawn-out kind of scenario at the moment, and if you get the ACCC involved,
we've had so much. We've had all these stocks rally so significantly. Many of them, even the good quality ones, are now at prices where it's going to take a year or two for the value to catch up, and so that means sometimes in my world there's just not a whole bunch of things to buy.
We're going to go to Bill from the Gold Coast. Hi, Bill.
Yes, Nina, I can assure you I am enjoying it very much. About 3 months ago, my advisor told me to buy the Telstra. At that time, they were about $3.50, and I did buy quite a few of them, but they seem to be going up and down in the one spot. I'm just wondering whether your expert panel can tell me what they think of the stock for the future.
Okay, Tatts, we're just going to chart up on the screen so our viewers can take a look at it as well. Roger, sorry, you're going to say something then?
Yeah, look, this is an example of the types of businesses I was describing just before the break, and that is it's a business whose price has got ahead of its value, and it's going to take some time for that value to catch up. So I just think it's a little bit expensive at the moment. The caller might find that the price continues to do that for quite some time.
And I promised our viewers we'd chat about Telstra. I'm going to go to that now because you mentioned the words out of favour, which is what Telstra was today on the stock market, down by 5%, of course, after reporting that 3.3% fall in first half profits. No change to the dividend. Plenty of people had hoped that it would go up, I think, from 14 to 15 cents. Hasn't happened. Shares down by 5% today, and there's a look at the chart, and you can see at the moment it's currently at $3.22.
I'll give people some perspective on this. You know, Jeremy, I love that quote. I love what you said. I wrote it down. It's been going nowhere for a while. Well, not only in terms of the share price, but in terms of the business. In fact, it's been going nowhere for 10 years. People are going to get sick of me saying this, but you've had mobile phone penetration in Australia go from 8 million subscribers to 22 million subscribers. You've had internet penetration into homes go from 35% to 85 or 90% now. And you've had, 10 years ago, you didn't even have subscription-based TV, not pay TV, subscription-based TV. That didn't exist 10 years ago, and now it's in 50% of homes. So you've had phenomenal growth in the businesses that Telstra is involved in, and yet its profit is the same today as it was a decade ago. There's been no increase in profit in that time. So it's a business that is going nowhere. The intrinsic value reflects that. The intrinsic value today is $3.12 and the share price is $3.27. The intrinsic value next year will be $3.47, the year after $3.54. It's about where the price is. I don't see a lot happening if the business continues in its steady state. The problem that you've got, of course, is it won't. You know, we don't know what it's going to look like in 5 years' time. We don't know what the government favours are going to be, if any. And so it's very, very difficult to value. I'm not surprised that it's out of favour today. It'll continue to be out of favour in periods if it continues going the way it's been going.
I think there's more upside in it, but not a lot. And you can't forget that for income-conscious investors, that dividend is sensational.
It was like a bond.
It is like a bond. It's very much like a bond.
Of the earnings out. It's just a bond. You know, with some optionality, I guess, if the government favours them and does something nice for them.
And I guess the difference is that unlike bonds, it's paying, you know, about 7% more than a government bond. So, I mean, it's...
But are there investors out there, and is this good, bad or otherwise, who just have Telstra because of the dividend?
Oh, yes, very much.
And is that good or bad?
It's the first time that the dividends have been paid out of profits, whereas previously it's been paid out of capital. You know,
on occasion.
Between 2005 and 2009, with Sol Trujillo at the helm, dividends exceeded profits by about $1.5, $1.6 billion. So this is the first time, you know, with Thody that, you know, the profits are actually paying for the dividends. That's a good thing. Absolutely. But, you know, people have bought... Now, you made that comment about people buying it for dividends. People have bought Qantas for the dividend yield, and yet the share price today is lower than where it was a decade ago. So what's been the opportunity cost of that? You know, you could have bought businesses like... the Reject Shop or Cochlear or CSL, you would have done a lot better.
Well, we had a fellow ring up on the program, I think it was yesterday, saying he's had Telstra for 14 years and it's back where it started.
Right.
Yeah.
So...
Well, it's true.
Well, because that's because the price was up here when it floated. You know, it got up to $9 in the peak of the... You know, well, the peak of the internet bubble. You know, it was up... people were saying it's going to $100 and it's going to $30 and all this sort of nonsense. And its value was at sort of $2 and $3. And Benjamin Graham's got this great quote. You know, I like quoting him because I think he's really sensible. And he says, in the short run, the market's a voting machine. In the long run, it's a weighing machine. So in the long run, price will follow value. And value for Telstra has always been about here. And the price does what it does, but eventually the price will catch up to the value, and that's what's happening now.
Good to have a chat about that company. Matthew from Moranbah, I hope I've said that right. Matthew, welcome to the program.
Yep, thanks, Nina. You got it right. I'd like to ask the panel's opinion on Highland Pacific, HIG. It's a Papua New Guinean miner with some gold and copper exploration that they're developing.
Okay, Highland Pacific, HIG, currently a 31-cent stock. Is this one that either of you are familiar with?
I know I've been doing some work on currency, converting reports to currencies, and there's 3 companies that report in the Papua New Guinea and Kina. You know, and I wonder whether this is one, but I don't know anything else about it.
Caller tonight, what's your question?
Thanks for taking my call. Just in reference to CSL, your opinion on that from a fundamentals perspective, thanks.
Okay, Jeremy, just quickly, not long to go.
I like CSL. It's been... I mean, it failed to make the acquisition of Telecris, which was a big plasma products producer in the States. Antitrust legislation and the regulators there stopped them doing that. That would have been a big help. And the fact they get a lot of their earnings in US dollars while the Aussie's been strong has held them back. Very good stock and a good buy at this price.
Roger, 20
Love
seconds.
it. Great. One of the great businesses in Australia.
Okay, well, that's a wrap for that. And that is a wrap for our show tonight. Roger Montgomery from www.rogermontgomery.com. I'm being careful
You don't have to worry about the WWWs anymore.
www.rogermontgomery.com.